You spent 12 years in school, maybe more in college. You learned quadratic equations, the names of ancient pharaohs, how mitochondria power cells. But nobody ever taught you the one thing that would shape every single day of your adult life: how money actually works. Not how to balance a checkbook, not how to save for retirement, but how the system itself is designed, who it serves, who it extracts from, and why you always seem to be running faster just to stay in place. This isn't an accident, it's architecture. Welcome to the financial system. Control the money, control the history, and remember, simple is never easy. Let's start with the first lesson school never taught you. Your savings account is not making you richer, it's making you poorer. Imagine your grandparents. They were told that saving money in a bank was the ultimate form of prudence. Tuck away a portion of your paycheck, keep it safe, and trust that it would be worth something when you retired. Governments encouraged it. Banks advertised it. Families built their futures around it. But what happened when inflation hit in the 1970s? Ordinary savers watched helplessly as their nest eggs evaporated. In the United Kingdom, the pound lost nearly half its purchasing power in just a decade. Families who thought they were secure found out the hard way that money sitting in a bank account was not wealth. It was a melting ice cube. Here's what no classroom ever explained. When your bank offers you 3% interest, but inflation is 6%, you're not earning. You're paying to keep your money still. That's not bad luck. That's the design. Lesson 2. Inflation isn't a natural disaster. It's a wealth transfer. Every time prices rise, you lose a little more of your freedom. Groceries, rent, gas, they all inch higher month after month. And if you've ever felt like your paycheck just doesn't stretch the way it used to, you're not imagining it. You're watching the quietest transfer of wealth in human history. There's a name for this. It's called the Cantillon Effect, named after an 18th century economist who noticed something crucial. When new money enters the economy, it doesn't touch everyone equally. Those closest to the source, the government, the banks, the elites, spend it first. By the time it trickles down to workers and savers, prices have already risen. The early recipients buy assets and goods at yesterday's prices. The late recipients, that's you, get stuck paying tomorrow's. Wall Street gets the money while it still holds value. By the time it reaches Main Street, it's already diluted. That's why quantitative easing after the 2008 crash boosted stock markets but left wages stagnant. That's why stimulus checks vanished into higher grocery bills and housing costs. Inflation isn't just a number on a chart. It's a wealth transfer dressed up as economics, and you're not on the winning side. Lesson 3. Debt is not a tool for you. It's a product designed to extract from you. Think about the financial advice you've heard your whole life. Buy a house, get a mortgage, build credit, use loans to invest in yourself. It sounds empowering. But here's what they didn't tell you. Every interest payment is a transfer of wealth from you to someone else, repeated month after month, year after year. A credit card balance is poison. Over time, it can grow faster than your ability to pay it. A house bought with a 30-year mortgage will cost 2 or 3 times its sticker price by the time you're done paying. That money flows upward to banks, investors, and financial institutions, while you spend decades working to service the debt. The system doesn't want you debt-free. If every household paid off their loans tomorrow, the money supply would collapse. Banks would have nothing to lend. Economies would grind to a halt. The machine depends on your participation, your willingness to borrow, spend, and believe the digits in your account represent something real. You are both the fuel and the collateral. Lesson 4. Your home is not an asset, not in the way they told you. Your parents' generation was told the safest and smartest thing you could do was buy a house. Property never loses value, they said. It always goes up. For decades, the house was marketed not just as a home, but as an investment. But here's the problem. A primary residence doesn't generate income. It drains money every month through mortgages, taxes, maintenance, and upgrades. It's forced saving, and worse, it ties you to massive debt. In Spain, the real estate boom of the early 2000s felt like a golden ticket. Families stretched themselves to buy property, convinced they were building wealth. Then, the 2008 crash came. Millions of homes plummeted in value, leaving families underwater, owing more than their homes were worth. Ireland's property market collapsed so brutally that whole neighborhoods were left half-built and abandoned. Even in the UK, families who bought at the peak of 2007 had to wait over a decade just to break even. That means rethinking what you call an asset. A savings account isn't wealth if inflation eats it alive. A retirement fund isn't security if it's tied to speculative bets you don't control. Real wealth is found in things that hold or produce value over time, skills that can't be inflated away, businesses that provide essentials, productive assets that generate cash flow even in downturns. Lesson 5. The system is not designed for you to win. This is the hardest truth, and the one school would never teach you. The financial system is designed to protect itself, not you. Inflation, debt, bailouts, these are not flaws, they're features. They're how the machine sustains itself. Look at the pattern across generations. Your grandparents were told to save, your parents to buy a house, you to invest in markets or crypto. 3 different strategies, one identical outcome. Wealth flows up the pyramid, losses fall on ordinary families. Every generation thinks it's playing a new game, but it isn't. It's the same script replayed with new actors. In ancient Rome, emperors debased the silver denarius until it was barely worth the metal it was stamped on. Ordinary citizens kept trading as if it was money, while elites protected their wealth in land and resources. In Weimar Germany in the 1920s, savings accounts were obliterated by hyperinflation, while those who owned tangible assets, factories, farms, or gold, emerged intact. In Greece, after the financial crisis of 2008, pensioners found their promised retirement benefits gutted, while foreign creditors demanded repayment first. The playbook never changes. Erode, inflate, crash, extract. Lesson 6. The people who win understand the game. But here's the part nobody tells you. Not everyone lost. In every gold rush, the miners got wiped out. But the merchants selling shovels, tools, and jeans became rich. Levi Strauss built an empire selling denim to broke prospectors. In every inflation, those who owned productive assets held value, while cash savers lost everything. In every housing collapse, those who rented smart or bought distressed properties walked away with gains, while others drowned in debt. The system is designed to take from the many and deliver to the few, unless you understand the cycle and position yourself differently. That's what real financial education means. It's not just learning how to budget, invest, or save. It's learning how the system itself is designed, who it serves, and how history reveals the patterns that repeat again and again. So what do you do with this knowledge? First, stop believing the system is designed for your benefit. It isn't. Second, understand that real wealth is not found in promises of the system. Real wealth is in assets that survive outside of it. Skills, networks, tangible resources, diversified investments that don't vanish when faith collapses. Third, recognize that a credit card balance is poison, while a fixed-rate mortgage can be leverage. The rich know the difference. Most people don't. That's how inflation turns knowledge itself into capital. Fourth, build around real, enduring value. Don't let inflation quietly drain you. Don't treat your home as your retirement plan. Don't chase bubbles dressed up as opportunities.
Focus on building and owning the things that survive crashes, outlast FIPE, and create real value. And finally, remember that financial freedom doesn't come from waiting for governments to save you. It comes from learning how the system works so you can step out of its traps.
History doesn't repeat, but if you don't understand it, it will crush you all the same. If this gave you a new perspective, hit subscribe. It's financial system, and history leaves clues. I show you where the money leads.